Interest rates and prices are still way too high. Inventory is very low. Sales are slow. Buyers are facing serious affordability issues. So is the housing market doomed? According to this article, two things can save it. Are they correct? Will 2025 be the year that housing market turns around? Later on, I will share with you the end of the year projections for the housing market of 2025 and my opinion on what to expect going forward. First, let's look at what it will take to save the market according to this article. The US housing market has had a tough year. Here's what could save it. America's housing market is finishing a year of high prices, sluggish sales, and elevated mortgage rates. But there are factors that could give it a boost next year. The Federal Reserve began to slash interest rates in September, but mortgage rates have actually risen since then. The average rate on a standard 30-year fixed mortgage was 6.72% this week. Freddie Mac said Thursday, up from last week, 6.6%. Mortgage rates are expected to stay stuck above 6% for the next 2 years. In September, when the Fed cut its federal funds rate by 50 basis points, it would normally be expected to ease borrowing costs, including mortgage rates. That didn't happen. Quite the opposite, in fact, leaving many people, even some professionals in the real estate industry, confused. This outcome can happen under specific circumstances. The federal funds rate is the interest rate that banks lend to each other overnight. It has a more direct impact on short-term interest rates, such as credit cards and auto loans. But its connection to long-term rates, like the mortgage rates, is more indirect. Mortgage rates are more influenced by investor sentiment and the performance of long-term financial instruments like the 10-year Treasury yield. When the Treasury yields rise, mortgage rates usually follow. And when Treasury yields fall, mortgage rates tend to drop. You can see how these are closely correlated here. And when you look at the Fed funds rate, it's not always following the same trend lines. Mortgage rates are highly sensitive to inflation expectations. Even though the Fed was cutting rates, if the markets believe inflation would remain high or on the rise, Treasury yields and thus mortgage rates would also increase. With increased optimism after the Fed's actions, investors may have felt more confidence about the economy's recovery prospects, shifting the funds away from Treasuries into riskier assets like stocks. This reduces demand for Treasuries, increasing their yield and driving up mortgage rates. In a normal economic environment, a Fed rate cut lowers the borrowing costs and stimulates demand, leading to lower Treasury yields and mortgage rates. When mortgage rates rise during the rate cut, it often signals underlying market concerns such as inflation and recession fears, which have been a continued concern for the last several years. Also, economic strength, where the economy is perceived to be resilient, leading investors to prioritize riskier assets over bonds, again resulting in higher mortgage rates. Policy skepticism, which makes sense given we just had an election. New administration is coming in with new policies, which naturally are going to cause some uncertainty in the markets. Also, doubt about the Fed's ability to control inflation and stimulate the economy effectively. It is complicated to predict mortgage rates. There are a lot of variables that could produce an unexpected outcome, like we experienced in the last few months. There are people that do this for a living and often get it wrong. Getting back to the article. Instead, the housing market's saving graces could come down to two things: continued job growth and more homeowners finally giving it up on their locked-in low mortgage rates and putting their homes up for sale. Jobs and inventory will drive home sales. Lawrence Yun, chief economist at the National Association of Realtors, NAR, said in an analyst note Wednesday after the Fed delivered its third consecutive interest rate cut. On a call with reporters Thursday, Yun said that the Lockin-Effect is becoming less strong, which could boost housing inventory or how many homes are on the market. Now, just a quick comment on what the lock-in effect is, in case you might not have heard of this before. It has also been referred to as the golden handcuffs. It's the idea of during the pandemic period, homeowners received low interest rates on their homes, whether through a purchase or a refinance. And as a result, due to the heightened mortgage rates, there is no financial incentive for them to move. This is a big reason we have been experiencing a very low supply of homes on the market, causing this historic imbalance of supply and demand in the housing market. Homeowners and buyers are getting tired of waiting for interest rates to come down. As of the first quarter of 2024, just under 60% of the homeowners with a mortgage had mortgage rates under 4%, and nearly 40% had no mortgages at all. That is slowly changing as time goes on and will eventually lead to a much needed increase of inventory. It just may take some time to get to that point. The job market's important role. The job market's health is always crucial for the U.S. economy. A steady paycheck means consumers can spend, fueling the economy in the process. Layoffs or the fear of potential job losses can cause home sales to decline, according to an NAR statement. Conversely, strong job creation can signal steady demand for home purchases, and would-be homebuyers gain confidence and equity required to buy. So far, so good. The job market remains in good shape, and fears that it could deteriorate have diminished over the past few months. Fed officials project unemployment to be historically low next year, according to their latest economic forecast released Wednesday. Of course, this makes sense. Strong employment numbers are a good sign for the economy, and we are at historically low unemployment right now. But also, wage growth matters a lot for affordability in order to bridge the gap in inflation that has clearly widened over the last several years. There seems to be a positive news on that front as well. In an article from The Street, a quote from Mark Palin, chief economist of Fannie Mae, notes that 2025 will remain challenging but offers a few areas of opportunity. We foresee the current affordability crunch hampering activity through our forecast horizon, but expect normal wage growth will outpace home growth for the first time in more than a decade in 2025, slowly but surely providing some much needed relief for potential homebuyers. Even with this positive news, we still have quite a ways to go to really put a dent into affordability issues that currently exist right now. But at least it is a sign of moving in the right direction. Jumping back to the original article, but a robust job market can also be a double-edged sword. A study from the National Bureau of Economic Research found that 1% increase in employment translates to roughly 1.5% increase in home prices. The median price of an existing home rose $406,100 in November, the 17th consecutive month of an annual increase, NAR said Thursday. Digging deeper into the research study by NBER, a lot of this was found to be correlated to a move towards remote work as a result of the pandemic shutdowns. It's been a few years, yet still has a notable impact on housing. Now, I'm not going to get into this right now. It's definitely interesting information. Perhaps we can touch upon this another time. Now, you want to reach out to your realtor when it comes time to sell, as remote work can have an effect on buyer preferences, depending on specific local market conditions and the locations. So you are optimizing the opportunities to get the highest net sale price for your home. And before I jump back into the article and the 2025 predictions, finding the right advice and assistance you need to give you a competitive advantage when selling your home can be tricky. If you need help connecting with a realtor in your market, all my contact information, including a quick form for you to ask a question or request help, is in the description below. More homes have to come on the market. A shortage of available homes has been a long-standing issue for the housing market. Freddie Mac estimated last month that there was a housing shortage of 3.7 million units in the third quarter. But total housing inventory increased throughout most of 2024, registering at 1.33 million units in the end of November, up to 17.7% from a year earlier. NAR's Young on Thursday said he expects more homeowners contending with life changes such as new children, divorce, or marriage to sell next year, freeing up more inventory and giving prospective buyers more choices. You know, over 20 years ago when I was in real estate school, my real estate instructor had talked about the 3 Ds of real estate: death, divorce, and distress. A bit of a morbid outlook, but an unfortunate reality that I am often faced with. There will always be a situation where inventory or homes are coming on the market, good or bad. Now, on the positive side of that, life-changing events, which are job promotions, upsizing for larger family, multi-generational living arrangements, retirement, and for some, just simply upgrading your life or simplifying your life. Over the many years of working with homeowners in real estate like you, regardless of market shifts, lifestyle changes have always been the primary reason for most of my clients' decisions to sell or buy. That hasn't changed, and I don't see it ever really changing in the future. The article goes on to say, a pickup in home construction can also boost inventory, which could occur in regions with enough support for residential development. Recent sales momentum, relatively lower cost, more plentiful inventory in areas where builders can build, household and more younger households are commonalities across markets in the South and West and are expected to see outsized home sales and price growth. Daniel Hale, chief economist at Realtor.com, said in a note Thursday. However, the Fed has signaled it's not in any rush to lower borrowing costs, which could affect the pace of construction nationwide. A slower path of Fed rate cuts for 2025 will keep builder and developer construction loan interest rates higher than previously expected and act as an additional headwind for gains in the housing supply. Robert Dietz, chief economist at the National Association of Home Builders, wrote in a blog on Wednesday. New construction this year, we may see some changes. With the new incoming administration and what Trump campaigned on, it will be interesting to see if opening up federal lands for building, incentivizing builders, tax cuts, and cutting regulations, and his other policies will have an impact, good or bad, on the new construction in the next few years. Let's see what the data nerds are telling us. Here are some of the predictions for 2025 going forward. Zillow expects for home prices to appreciate by 2.6%, downgraded from 2.9% from a previous forecast. Similar pace to what we saw this year in 2024. Zillow notes that inventory is improving, while not providing any specific predictions on numbers, but they have commented inventory is about 26% below pre-pandemic levels, the smallest shortfall since September 2020. Zillow predicts 4.16 million existing homes in 2025, up slightly from 4.06 million from the previous year. Zillow commented on rates will gradually decline through 2025, but stay above 6%. The slight increase should contribute to home appreciation and increased home sales. Redfin expects home sales price to rise by 4% by the end of 2025. Reason is they believe the lack of inventory won't meet the demand. Redfin believes mortgage rates will stay near 7%, suggesting economic factors and policy changes will keep them on the higher end. Home sales to be around 4.1 million to 4.4 million. An interesting comment made by Redfin believes that 2025 will be a renter's market, in direct opposition of where Zillow believes rent prices will increase, making rental less attractive option. Redfin's position based on the idea that rents will remain stable while wages increase. Realtor.com forecasts home price appreciation will be 3.7% year-over-year increase. Existing home sales 1.5% year-over-year increase with a 4.07 million sales for 2025. And existing inventory 11.7% year-over-year increase. They're predicting mortgage rates at a 6.3% average throughout the year of 2025 and ending around 6.2%. Realtor.com commented that it will be the first balanced market in almost a decade. Increased growth in rental stock and improved home affordability for renters due to flat rental prices and increased wage growth. It's important to mention these companies will revive these predictions as new data comes in going into 2025. It will largely be driven by the direction of the mortgage rates, employment, inflation, and the economic shifts. So is the housing market doomed? The article seems to have a positive outlook on it, suggesting it is not. The forecast, while moderate, seem to be leaning in the positive direction. My opinion, it's definitely not doomed. Not even remotely. Can and does it need saving? That is a bit of an exaggeration as well. We have problems. It needs to be more balanced and evenly towards the buyer side. Wage growth needs to catch up. Mortgage rates need to slowly move down into the 5%, and I stress slowly. Appreciation needs to decelerate, and we need more available homes to meet demands. That's a lot. We have a lot of work to do before we see noticeable results. I said this before, and I'll say it again. We are in for a slow grind sideways and up. A crash is highly unlikely, and many of us will feel the pain as the markets heal. But the housing is not doomed. Based on many of the predictions, I agree with much of it. In the best case scenario, rates peak into the low sixes and maybe even the high fives towards the end of the year. But I imagine we will float closer to middle sixes to sevens in the first two quarters. I think for real growth in sales to happen, we have to get closer to 5.5 to 5.75%. Before we can get there, we have to see more inventory come on the market, or it could shotgun us back to the extreme demand with low supply that we saw back in the 2021 and early 2022. Appreciation will slow, but prices won't likely go down and inventory will slowly increase. So what do you think? Are we doomed, or do you agree that we are just grinding out year by year, hoping to hit a more balanced market over time? Are you waiting on the market to shift? Let me know in the comments below. Now, if you have a question or you are looking for a realtor in your area, I can get you connected with someone that will treat you right. All my contact info is listed below in the description. If you found this information helpful, check out this next video. See you next time.